Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I am your host, Ed Lopez, and my special guest today is Jeff Hirsch, editor of Stock Traders Almanac and chief market strategist at Probabilities Fund Management. Jeff, so great to talk to you. Thanks for joining me today.
Pleasure's all mine. Thanks for having me.
You know, you guys have a lot of great data in the Stock Traders Almanac, and what you do, I love what you do in terms of collecting market data over decades to try to identify different patterns and trends and seasonality, and it's super interesting. And I want to dig into some of that. I definitely want to dig into the election cycle this year. I think that's a great topic to talk about. Talk about the worst 6-month strategy, which I think is probably coming to an end pretty soon.
We're smack dab in the middle of it.
Okay, still in the midst of it, so which is great to talk about.
Mm-hmm.
And then, but perhaps we can take a step back and just kind of talk about the Almanac, how it was started. I think there's a great history there, and I'd love to learn a little bit about you as well. Can you tell us a little bit about how the Almanac, the genesis of the Almanac?
Yeah, well, it was started by my illustrious father, Yale Hirsch, who is 97, will be 97 in October of 2020. He's living in a nice nursing home. Well cared for. He was working in the songwriting entertainment industry back after World War II. He actually hitchhiked out to California when he was about, 20-something. His cousin, my cousin, who my first son's named after, Samson Kozla, was a famous songwriter and Hollywood producer, wrote Cocktails for Two, My Old Flame, produced Copacabana, amongst other things. Has an Oscar and was in the Songwriters Hall of Fame. Sam sold his publishing company to, I think it was RCA, his music publishing company, for stock. Stock tanked. He got burned. Got pissed and went and figured out the stock market. A smart guy, obviously. And he ended up writing a book called Super Yields and starting a publication called Indicator Digest out of Palisades Park, New Jersey. Back in 1961, I believe it was. He ran an ad in Barron's, the old A-B split, but they had two presses. So you have one headline here, and it was a great way to test marketing headlines and offers and stuff. Ran the ad in Barron's. It hit. Called up my father, who was writing songs. I actually took over one of his little music publishing companies. We have a couple tunes that he owns. And asked Yale to run operations. And over the next several years, Yale became a student of the stock market and market psychology, cycles, seasonalities, patterns, trends and indicators. And Indicator Digest ended up being quite a proving grounds for analysts and writers over the years. Just about the time that my mom was about 6 months or so pregnant with me, he decides to go out on his own. He has this epiphany to take all of these patterns, trends, cycles, and put them in a calendar format so he could follow the market schedule along with his own, and went to work. He incorporated in 1966, February. I was born in May. He spent the next 18 months or so researching, putting together. I still have his stack of Barron's lab pages back to the 60s. We don't necessarily use them anymore, but over the years, I've had to go back and refer to them to check a number here and there. So he put out the 68 Almanac when I was about 1.5 in 1967, the fall. Brokers, back then advisors now, ate it up. They gave it to clients as gifts. He had a salesman go around all over New York. And the rest is sort of history. So I was basically born, bred, weaned, raised on it. Started looking at charts and looking over his shoulder over the years, and ended up running the numbers, as I say, which is not a bookkeeping, but doing the math with the calculator and an adding machine and graph paper and stuff. So that's how it started. Then we branched out into newsletters and now a little money management too.
What's your earliest recollection of it? I mean, did you kind of help him out in the summer sometimes, or before you actually got involved with the company? Stacks of paper, things like that? Oh,
my God. I used to duck under his cloud of cigar smoke in his office. He put the office in the house. He used to work late, so he ended up moving the office back to the house. I used to duck underneath it to kiss him goodnight as he was working. And then I remember, when we had the office in the house. He put on a new garage. They redid the old garage. He didn't want to go into the city anymore. It was kind of a pain in the rear for him. And I remember going into the dining room where we used to spread out papers everywhere and charts, and they used to have the book that came in. The name escapes me now. We also got the chart book, Value Line, all that stuff. I remember just looking over charts. I think it was Polaroid, And I was coming in to say goodnight. Usually him and his writers are working. And he said, well, what do you think the stock's going to do? And I'm like, looking at the charts, like, I think it's going to go up, That was about the earliest memory. And then, packing books, shipping them out. I used to load the truck. Well, the invoices and labels, we had them imprinted for brokers. I mean, I have one with probabilities fund on it over here in the office, but mailroom, answering phones, I've learned how to be a receptionist, from day one. Hirsch organization, can I help you? It's just, it was a business in the house. It was all part of our life and family.
The markets that you cover with the Almanac, U.S. equities or other asset classes?
Mostly U.S. equities, small caps as well. We do things in sectors and commodities, though we do try to correlate ETFs and stocks with commodity seasonalities, but we do look at the futures and provide strategies. We did do that Commodity Traders Almanac for several years. I think you actually are one of the wonderful people that have a copy or were aware of it. It's a lot of work for not as many people that want it as the Stock Traders Almanac. So we have the rights to it back from Wiley, but we use all that in the newsletter. And
in terms of how you might recommend people use the information in the book, there's a lot of different patterns and seasonality storylines that you point out. I was flipping through again today, just kind of looking at the highest probability of a positive return on any given day in the year. What's the best way that's for somebody to apply this in their investment process?
I mean, if you don't know by looking at it, you have to figure that out. There's a lot of traders out there who use it, who have all sorts of technicals, and you have to realize it's not something that you're going to just rely on solely. I mean, we use 5 disciplines in the newsletter. I look at psychology, sentiment indicators and that sort of thing, as well as fundamentals and technicals and monetary and government policy and seasonality. So it's one of the tools, and you have to take seasonality into consideration with what you're looking at out there. I mean, there's one simple thing that people can do is the best and worst 6-month switching strategy. I know you want to get into that later, but that's a simple thing. It's two signals a year. You buy sometime after October 1st, and you sell sometime after April 1st for Dow and S&P, or NASDAQ is after June 1st. And that has produced some of the most solid, evidence-based, back-tested results. I had David Aronson, who did the evidence-based technical analysis book, put it through its paces back in 2008 when we used to pick best investment books for the Almanac. And that's probably the one thing you could do, just the best 6 months or best 8 months for NASDAQ switching strategy. Otherwise, you use it to generally lighten up and tighten up at certain times of the year. And, you don't want to be buying a stock every single month. You want to be getting into stocks after we get the third quarter correction, if we do get it, or even during that summer pullback that we normally have, and starting to trim losers, underperformers, and tighten up some things in the spring months. So it gives you the general flow of the market. With the election cycle, there's also triple witching and even intraday trading patterns, which we have in there. So if you're going in to pick up a position in something, whether it's Apple, Google, or the GLD or whatever, and you have a price that you like, get it. Or just chase it. Wait till about 2:30 on any given day normally, and you probably come back to where everyone goes and gets that coffee or Diet Coke, and they need to take a break after lunch. Even if they're not on the trading floor, they're sitting in their house, on the COVID scene. You got to get up and go get something to shake the cobwebs out and finish the day. So that's usually when you see that low point.
What's the most amazing pattern that you followed?
The best 6 months. On the longer term, it really persists. People continue to poop. Everyone calls it sell in May, of course. Yeah. And they forget what it's all about. I mean, it's really based upon human behavior. And, basically the landmass of the planet Earth is mostly above the equator, right? I mean, there's not a whole lot south of the equator. So most of the action is based upon the seasons that we live in up here in the States and in the North. And you have a general change of pattern of behavior with more sunlight being out there. People do different things. It's turned into the Memorial Day to Labor Day, summer period, the vacation period in, London, as we know from watching Downton Abbey. It's the London season, which was from September, through May, when they would because London was built on a swamp basically, and it's pretty, muggy and stuff in the summer, and business slows down, and therefore the market does. So the sell in May phrase, sell in May and go away, the rest of it is come on back on St. Leger's Day.
Huh.
And St. Leger's Day is the day of the St. Leger Stakes, the final leg of the British Triple Crown thoroughbred horse racing Triple Crown. And it's basically in mid-September. So it's when people finish up their summer season fox hunting, in the old days or whatever, but people still go away and get out of the heat of the summer. And then they come back in September, which is when we have our back to work, back to school, end of third quarter window dressing. You throw in the mutual fund, October 31st deadline for certain transactions for distributions. And you have this collective behavior of human beings around the world that do less business during the summer months. It shifts, it changes a little bit. That's why we have it going to June now a little bit more with NASDAQ, but you still see August and September being those low periods. If people will go back to 1896 when the Dow starts and try to disprove the sell in May or best and worst 6 months, guess what? Back then it was a farming economy. It was an agrarian economy that was built on, and cash flow was generated through farming. So it was pretty much buy in May. Buying seed and feed and fuel and hiring, and market would rise up through harvest time. So it's sort of a moot point. It really doesn't kick in until, post World War II.
Yeah. Well, let's continue talking about the strategy. Is the strategy that simple? Technically sell everything that you have in May and then wait until September to come back in, or what?
It can be if you want it. I don't recommend doing it just that simply. We use a technical timing indicator called MACD, which I'm sure many people out here are familiar with, developed by the recently passed Jerry Appel. His son and I, Marvin, are friendly. We use Jerry's original MACDs, 817.9 for the buy side, 1226.9 on the sell side. We start looking for, and this was something that another gentleman who's left us, Cy Harding, had proposed or been a proponent of in his book, his 99 book, Riding the Bear. He said he took Hirsch's best 6 months and Appel's MACD, and you got the best mechanical system ever. And it's true. And it triples the returns of the straight best and worst 6 months, because you get it, out a little bit earlier before as the market turns in, or stay in a little bit longer, or get in a little bit earlier. You want to catch that turn, at the end of the third quarter, beginning of the fourth quarter. And then it's about what you do. You don't have to sell everything. I mean, we call it reposition in May. I was mentioning it earlier, where you get that sell signal. We start tightening up, lightening up, getting rid of losers and underperformers. We always hang on to winners. We might tighten up those stops a little bit. And we'll get into some bond ETFs over the summer months, because they usually go the opposite direction of stocks. Though with ZERP out there, that's a little bit different. There's a few other sectors that do well in the worst 6 months. So it's kind of a calculated rotation, a general mindset from risk on to risk off, but not sell everything. But again, with the three or four main ETFs, diamonds, spiders, cubes, and the IWMs, the Dow, S&P, NASDAQ, and Russell, we'll sell those and rotate into bonds. But with the other parts of the portfolio, stock keeps going up, we're hanging on to it. No need to sell a stock that keeps rising. Let your winners ride, sell your losers short. So it can be black and white, but it doesn't have to be. And I think it's better if you add some of these wrinkles that I'm talking about.
Yeah, and was there a little bit of a sector story to it too right now? And does that change over time, that sector play and during this period?
The sector story, everything changes over time a bit, and that's the challenge. And we were talking about going back decades, when we were sort of mentioning the whole thing in the beginning. It's the trick is to finding that sweet spot or combination of long-term and short-term. So we look at different time frames, and if we find consistency over going back 70 years to like 1949 and back 35 or 31 years, something to 71, or post 87 crash, and then the most recent 21-year period, and we see similar behavior over the different time frames, then we're on to something that's more solid. So there's a group of sectors that do well in the worst months: utilities, staples, healthcare, Biotech picks up at the end there. I mean, I think healthcare and biotech are going to be around for a long time, considering guys like my father still, kicking around at 90, 96, 97. But there's definitely a sector seasonality, and there's a whole part of the Almanac that focuses on the different stock sector seasonalities, along with, we bring in the commodity seasonalities as well. And different countries have their own seasonality. We've done a little work on some others. I did a presentation over in Hong Kong a few years back, and I put together the seasonal patterns for the Hang Seng. That's arguably going to change with, China sort of taking over, but there was a clear and interesting seasonal pattern around Chinese New Year, because it's a huge cultural event that makes people behave in the same way collectively over a long period of time.
And how's that strategy working so far this year in 2020? Just given the level of unprecedented, liquidity and central bank support in the markets, does it change anything? Or have you seen?
Yes, it does. I think the pandemic and shutdown changed more than the money is right now. There's like $13 trillion swirling around from central banking fiscal stimulus, in addition to the open checkbook and press rolling out of Mnuchin's office. That's one of those things that we quoted at St. Gould a little while ago. This is one of those things where seasonality got, overpowered by a coronavirus and an economic shutdown. But it came back pretty quickly. It's also at a point right now where we've sort of hit valuation numbers, and we're hitting that seasonal time where I'm of the belief that the seasonal patterns, the weakness in the third quarter, August, September, can materialize. We're definitely more news driven at the moment with vaccines and diplomatic machinations with China and that sort of thing. And the election, of course. And it's a very critical 3 months for a president who's going for re-election. We could segue into some election cycle stuff if you want me to go there.
Let's go for it. Yeah.
Yeah. There's a page in the 2020 perspectives, election year perspective. I think it's page 20 or 26 or something like that.
I feel like I'm opening
list a whole bunch of things. The calendar changes a little bit, so some of the pages shift each year. Presidential election perspectives, page 26. There's one of them on there from our good buddy Sam Stovall. I know some other people who have picked it up out there, but it's really something that Sam created and discovered, the presidential predictor, how the S&P performs from, you could even quote from it there yourself, from the end of July to the end of October, has about an 85 or 88% chance of predicting the re-election of the president. Let's see, the numbers that 7 of 8 on the downside for 88%, he gets kicked out, and then 11 of 13 on the upside, the party retains power when the market's up then. So that kind of number is pretty impressive. You get into the 80, an 80 handle in the percentages, you're looking at pretty reliable indication. So pretty sure the president's aware of that. Another page in the 2020 Almanac is called How the Government Manipulates the Economy to Stay in Power. That's what creates the 4-year cycle. People are talking out there these days, is the election or the pandemic manipulating the market? I'm like, yeah, the election has been manipulating the market for years. That's what creates this 4-year cycle. So we're into that period. Good news is solid rally in any of the cases in the fourth quarter after the election, kind of a relief rally. If the president gets kicked out, it's usually from a lower point and a more robust rally. If there's a reelected, or a party retains power, it's not quite as quite much magnitude during that fourth quarter rally, but it's there.
And then what about, and you may have touched on it a little bit, but in terms of expected performance for the market itself in an election year, going into this year or trying to finish out this year, what does the data say in terms of expected performance?
Well, it was expected to be quite a bit stronger with a sitting president running for re-election. NASDAQ is holding true to that, but with the, a lot of the old school economy being held back by the lockdowns and the, social distancing measures, it's been tampered. Election years have been less bullish over the years. We've seen some battleground issues. We had the dimpled Chads in 2000, the undecided election. People are afraid of that. Any sort of thing that happens where the election is not decided on election night and it gets challenged is bound to be negative for the stock market. And we're hearing talk of that right here. And if I were to be a gambling man, which I am, the banter about that may, impact them and keep it down a little bit more. Right now, everyone's pretty gung-ho on FANG and the work at home economy and the low rates. So there's a lot of things going on here that have the potential to keep this market at bay for a while, let alone valuations and technicals and civic unrest. May you live in interesting times,
Yeah. Yeah. Let's step back a little bit and talk a little bit more about you in terms of just kind of your schooling and coming into the business. Was there ever a question that you'd go into the family business?
Yeah. For about 30 years, almost, 27 years or whatever it was. We've all got our egos, our desires to do something different. I think my son's realizing that it might be actually beneficial for him to come in, but yeah, I know I wanted to be different. I want to do something else. I didn't know what I was doing. I went to AU for a while. I was a philosophy major. Still work with my father a bit on the side. And it was my friend, my good friend, oldest friend in the world, known since 1950, him and his brother. He says, Jeff, what are you doing? Go work for your father. So I did. I went in there and I said, look, I'll come in, but I want a title and I want, a salary. I don't want to have to be clocking in. So it happened. I guess it was destined, even though I fought it tooth and nail for a while. But I came in, I did everything. I learned this business from the ground up, from the mailroom up. I did the calculations by hand, and then I came in, I converted it to Excel for DOS and then for Windows. And that's about the capacity of my programming skills. So somebody else is taking it to the next level now. My brilliant director of research, Christopher Mistel.
What's the most important thing that you've learned from your father?
Don't judge people, and just also accuracy and just being, going through the data and just being studious of it. I guess the other thing is just to look for what really happens and not be, with the cycles and stuff. If people want to put it into the 4-year cycle, the 10-year, the 17 and a half, he's like, look for what changed. Look for the event or the where things shifted, and that's where that cycle started. That's why we look at, people go back to 1900. It's a different world. We look for when things changed, when the New York Stock Exchange put in all the circuit breakers, if the A7 crashed, to look for events and things that change human history and change cycles and patterns in the market.
So what about another influence on your life? I'm guessing it's an influence. It's an influence on mine. I heard that you're a rugby player.
Mm-hmm.
Are you still playing?
I have not played for about, I played a few old boys matches in the late 40s. I haven't played in my 50s. I did wrestle my 15-year-old son the other night. I had a lot of weight on him, but he's still a little beast now. But rugby was, it's the biggest international fraternity in the planet. Like if you meet people that play rugby in any language, any part of the world, and I have in other countries, it's just like, oh my God, what do you need? It's quite a fraternity. I played a little bit for American, but I had other distractions down there. And then it was mostly in my 20s and 30s. I would play, I'd show up at work on Monday morning with this, my front row shiner scar scrape thing from going into the.
That's right. You said you played hooker.
Yeah,
I don't envy that position. They try to get me to play that every now and then. But
I could bend myself in half and strike on. I mean, back then we were able to steal against the head. Take the on the scrum down. So on the put in. So it's still a great game. My younger son plays. He plays over in Greenwich. Not right now, obviously, but
yeah.
Stuff.
I agree with you. I mean, I loved it from the first hit I ever took.
Oh yeah.
I started playing in college, and that was it. And I loved it.
I wish I had learned how to rugby tackle first before I played football.
You know what? I was going to ask you about that. What do you think is safer, American football or rugby?
Rugby.
Yeah, it's because you learn how to tackle, right?
I watched. My son has some European coaches over there, and Alistair, obviously British, kind of a second row size guy. He says, put what smells on what smells. So you put your head behind the guy, put your shoulder on his thigh, you put your shoulder on his butt, as opposed to American football, where you come in. We used to try to get that stick mark on the face mask, and you can't come in head first. In rugby, you don't have a helmet on, so it's definitely safer. And the rules, you can't hit a guy who's up in the air. You can't play when you're on the ground. You
got to wrap up.
You got to wrap. You can't tackle above you can't high tackle. I mean, there's so many more laws, as they call them, which I'm learning more of them now than, in the front row, you just, it was offside. You stay behind a ball and, pick and drive, man,
So for the people listening who don't know rugby and don't know what the position hooker is, he's the guy that's in the front row.
In the middle of the scrum.
In the middle of the scrum, propped up by two other guys by props. And he's the front row, putting their heads and shoulders, locking in with the opponent and pushing like all hell, and they're trying to hook the ball back to their teammates.
With their foot.
With their foot. That's, I guess, where the term hooker comes from.
I found out accidentally when I was going to strike on the ball once that being limber enough, I could actually inadvertently knee the other hooker in the face as I was striking on it.
Oh, we had some dirty tricks, man. One of the guys on the team would get in one of those rucks and bite himself on the hand and then call a foul. Oh, it was fun.
Yeah. And I remember people trying to punch me, and I'm like, are you kidding me? I just ran full speed in with like a 250-pound man. You think your little punch is going to bother me?
And, thinking about about what I call kind of the brotherhood of rugby, I'll give you a quick little story. I was playing this other team, and it was obviously in college, and I was running with the ball. I'll go out to stiff arm the guy, but my fist didn't quite open up in time, and I ended up punching him in the eye. I didn't get called for it, but they were tagging me the rest of the game, just knocking the shit out of me the whole rest of the game. But at the end of the game, I thought this guy didn't have enough of me. He came up to me. He looked really mad. He came, scrambling up to me. He goes,
nice
dude.
stiff arm.
No, he goes, dude, my girlfriend's pissed at you. Let's go get a beer. Like, all right, good. Yes. Yeah, that's exactly the way it is.
Yeah, a lot of camaraderie between the teams, which you don't see enough of out there. Everyone shakes hands and goes and hangs out together with the other team.
Going back to markets, you mentioned biotech earlier, biotech and health stocks. COVID has probably been a boon for them. Do they end up getting sold off if there's a vaccine?
There's a bit of selling news, but not necessarily, because if it actually keeps going and they're making more of them, there'd probably be a bit of a sell-off initially, but I don't think it's, more than selling a news thing and not going to turn it down. The ones that fail, that don't come through with things are going to sell off more. The successes will probably continue to go up, maybe after a little bit of a dip. We happen to have Regeneron on our stock pick list that came through our screens, our fundamental screen back during, was it October 19, when we start looking for that new basket of growth stocks. So we look seasonal, buy period for the best 6 months, fundamental screen with acceleration of growth, revenues and earnings, as well as technically set up and a little bit under the radar. So those kinds of stocks, I think, can do well. And I think it's the sector for the future. It's the ultimate tech. You go for your annual stuff, there's tests and they're doing everything to you. A lot of it's, CYA activity by the doctors to make sure that they don't miss something, but there's just more and more health stuff going on.
Yeah. So typically we would ask, what's one long-term trend you see playing out over the next year, several years? I think that's basically it, right?
That's one of them. I think zero interest rate stuff is not as long as the super boom, but Powell himself has said it. We're going to be looking at near zero rates for at least a couple of years. There's a few other things out there. I'm just concerned about the whole commercial real estate business. So the mega office complexes, they're seeing stores and restaurants and companies close down. I mean, this pandemic thing is going to change that. I mean, how many times have you been out to dinner in the last 4 months?
Twice.
Right. And you sat outside?
Sat outside. Yeah.
Yeah. Or inside,
nervously
far
outside.
away from people.
Yeah.
Nervously. I mean, I went down for, a cappuccino the other night just by myself. It was quiet in Piermont, and, where we live in New York. Streets were quiet. It was great. I mean, I had a nice relaxed night. A little Perrier and a cappuccino, and it was a quiet thing, but, about 10 yards away from everybody. So how do you see that industry going?
So you touched on it on one of them, but we do a segment called Trend or Fad, where I mention a few different concepts, and you let me know whether you think it's a trend or fad. I'll start out with one that I think you already touched on, but work from home, trend or fad?
I think it's a trend. Probably fizzle out a little bit. I mean, I'm working from my office, but it's not a huge office building. It's me. So
yeah, it will be interesting to see how the commercial real estate market plays out and how much of that really keeps after all of this. How about connected home fitness, trend or fad?
That's a fad.
Deglobalization, trend or fad?
I think it's a fad. I think it's impossible to not stay connected globally with everything going on these days.
And cryptocurrency, trend or fad?
Blockchain trend, cryptocurrency fad.
All right, fantastic. Jeff, thanks so much for talking with me today. How do people find you? Where should they look for you?
StockTradersAlmanac.com or probabilitiesfund.com.
Check out the website, get the book, get the Almanac. Again, thanks very much. I really enjoyed the conversation. See you soon.
My pleasure. Ruck over.
Ruck over.
Thanks, Ed.
Thanks. And thanks for tuning in to another episode of Trends with Benefits. I'm Ed Lopez, your host. Until next time.